Did anybody get taught this at school? No? Has anybody used it since? No. The guys putting their hands up are probably engineers. I've only ever used it once to build a rabbit hutch. Did anybody ever get taught about these at school?
No. They didn't exist when I was.
Has anybody actually used them? Pretty much everybody. So I mean, like, fundamental facts about the way money works isn't taught at school. And it's even deeper than simply knowing how to get the best deal on a credit card or on your mortgage. It stretches right to the depth of where money actually comes from. That's what we're going to talk about for the rest of the day. Okay, so firstly, who creates money? Where we are today, obviously, I mean, everybody knows these are created by the Bank of England, by the government. It says on there, the clues on the note. But actually, this type of money now only makes up 3% of all the money in the economy. So what's the rest of it? The other 97% is just numbers in a computer system. Nothing else. So where did this other 97% of all the money come from? Well, this is Martin Wolf, the chief economics editor of the Financial Times. The essence of the contemporary monetary system is the creation of money out of nothing by private banks, often foolish lending. You couldn't really sum it up any more succinctly. Creation of money out of nothing by private banks, often foolish lending. Okay. Some people aren't totally convinced by this. So we have some quotes from the Bank of England. The money creating sector in the United Kingdom consists of resident banks, including the Bank of England, and building societies. Money creating sector? I mean, most people know that if you try and print your own 10 or 20 pound notes at home, the police are going to come through your door at 2 a.m. the next morning. So how come there's this money creating sector that includes banks and building societies? Here we go. When banks make loans, they create additional bank deposits for those that have borrowed the money. Okay. Paul Tucker, the second in command at the Bank of England. Banks make loans by simply increasing the borrowing customer's current account. That is, banks make loans by creating money. By far, the largest role in creating broad money is played by the banking sector. When banks make loans, they create additional deposits for those that have borrowed the money. Anybody still doubtful? Well, if you were still doubtful, here's a letter from the Bank of England that one of our supporters wrote in with some questions. He said, when a commercial bank makes a loan to a borrower, does the commercial bank in effect create new money? In other words, when a bank makes a loan to a borrower, is that money just created out of thin air? And they just responded, when banks make loans, commercial banks do indeed create much of the money in the economy. So effectively, we have almost a fully privatized money system where all the money that we are using is created by private banks out of nothing when they make loans. So this is where we are. Very few people understand this. Banks create money. All the evidence is there. It's not a conspiracy. It's just fact. It's just the way it works. So how much money do they create? Okay. Well, the key question here should be who decides? Who decides how much money they're going to create? If you walk into a bank tomorrow and ask for a loan, you're going to have to discuss this with a mortgage advisor or one of the bank tellers who are going to help you see if you can actually afford that loan. So these guys at the bottom are deciding whether to make loans to people. And every bank loan creates new money. So these people are actually deciding whether to create money. They probably don't know it because most people at the bottom of a bank won't really understand the way the system works. And let's look at the incentives that these guys have. So, you're working in the bank, you're on a fairly modest salary, but you also get bonuses for every loan that you make. You get a commission. That's your incentive. So you have this decision when you're working in the bank. Either you lend or you don't lend. Okay. And if you lend, you can get a commission. You get that bonus at the end of the year if you've hit all your targets. You get to keep your job. And you have this opportunity of getting promoted if you're performing well. If you don't lend, well, there's absolutely no benefit. There's no rewards for bankers that don't lend. And if you consistently don't lend, then you get fired. So when the incentives stack up like that, what are you going to do? You're going to lend. Okay. So when somebody comes in asking for £1 million mortgage on a house that they can barely afford, but you know that you're going to get potentially a 10 grand bonus for actually sealing the deal on that mortgage, then your incentive is to lend them the money. You're not going to worry about, the money supply of the economy or the bigger economic issues. So these guys are creating money every time they make a loan. They don't necessarily realize that they're doing it. And the entire sales culture is driving them to lend as much as possible, which is basically blowing up the money supply as quickly as possible. These corporations are creating money, and it's systematically set up so that they're always going to try and inflate the money supply and create as much as possible. The guys at the top, they maybe understand that it is creating money, but they don't ever consider the impact that will have on the economy. And when you look at banks the size of RBS, HBOS relative to the UK economy, the fact that they don't consider their impact on the economy and how that might feed back, that's scary. So how much money have they actually created? Well, the cash, physical cash, currently adds up to about £57 billion, which, to put it into perspective, is about 19 Richard Bransons, or enough to buy 351,000 houses. The electronic money that the banks create, there we go. And this is perfectly to scale. £2,200 billion, which is 733 Richard Bransons, 13.5 million houses. To put that last number in perspective, it's basically enough money to buy half of all the houses in the UK. There's only about 22 million houses in the UK. And you can break this down by year as well. This is all from Bank of England figures. So in the 90s, they were creating an average of about 40 to 50 billion pounds of new money every single year. And then in 2000 onwards, it started to increase. We got 68, 66, 98 billion pounds of new money pumped into the system in 2004. And then it really gets out of control. And this is your house price bubble. This is why houses were getting more expensive. And then we had the credit crunch, and they stopped creating new money. Because we were so dependent on debt by that point, that's when the economy really started to grind to a halt. Put this into perspective, in 2006, 171 billion pounds of new money created, adds up to about 3,800 per adult in the UK. Again, Professor Charles Goodhart, the supply of money is actually determined primarily by the demand of borrowers to take out loans. So if we're willing to keep taking on the debt, then the money supply will expand. And if you have banks with incentives, as we've seen, then the money supply will expand. We would add one other thing to that statement, which is that it also depends on how confident the banks are. If they're confident that the economy is going to be good, they'll keep lending. If they're panicking, then they'll refuse to lend. So I mean, basically, the money supply, which is the foundation of the economy, depends on the mood swings of bankers. What do the banks do with the money? Well, this is the fairy tale of banking, which you still hear in the press and you still hear in economics undergraduate courses. Banks take money from savers like my grandmother, like anybody who's saving up for their pension, and they then go and invest it in businesses, and that helps the economy grow, and it creates jobs, and it means, we all get richer as a result. So, two types of lending that a bank can do. There's productive lending into things that will actually grow the productive capacity of the economy. Now, this is not productive in this sense, doesn't mean that the loan's going to be repaid or that it was a wise decision to make the loan. It means that it will actually increase the amount of stuff and services that we can produce as an economy. And then there's the non-productive lending, which is things like housing, things like speculating in the financial markets. This doesn't actually increase how much stuff we have. It doesn't create new houses, it just makes existing houses more expensive. So we're going to do a quick quiz. Okay, what percentage of bank lending do you think goes to business? 50%, 22%, 8%, or 75%? 8. This is absolutely correct. 8% of bank lending goes to productive businesses. Good. The other thing as well is that all that unproductive lending, all this property and speculation lending, doesn't add anything to growth. So when you hear about the economy's in recession, we declined 0.1% last year, or we've grown by 0.1%, which actually I think means that somebody found a fiver down the back of the settee and spent it. Well, none of the bank lending that goes into unproductive lending will increase growth. Only this here will actually increase growth. Only that will actually really create good jobs that aren't, just pure speculation. Okay, so this is what they do with the money they create. They pump a lot of it into housing. We'll hear a lot more about this afternoon, but this is what average house prices have done since 1952 when my grandparents bought a house. The average house back then was about £1,800. It's now about £188,000 and rising again. So why is there this bias against lending to businesses? Well, think about it. You're a bank. You can lend on a property. And if that property loan goes bad, if the person doesn't repay you, you can repossess the property. Now, if you lend to a business, there's usually very little that you can repossess. I mean, if it's a sandwich shop, there may be a bit of equipment there. If it's a service business, the chances are there's absolutely no real physical assets that you can repossess and sell. So the risk on a business loan is much higher. There's also the Basel Capital Accords, which build in, without going into the details, they give banks a systematic bias towards lending for property. It makes it more expensive to lend to businesses. There's also the fact that your average business loan might be 30 to 100,000. Your average mortgage these days is going to be 188 to $250,000. So it costs even more administration to make a loan to a business. Going through the business plan, speaking to them, see if they know what they're doing. Whereas with the housing loans, a lot of it's automated. So the actual cost of arranging that loan is much lower for the property. So basically, banks are systematically biased towards lending for property. And this is really quite a fundamental problem because the capitalist system, the idea is that money will flow to productive businesses. And actually what we've got now is a system where the banking sector actually doesn't want to lend to the productive part of the economy. That's going to lead to the system collapsing. So this is why you have so much unemployment, so much joblessness, because banks just don't invest in productive business. Only 8% of it goes into that. The other 92% goes into the gambling and speculating that's blown up the economy and led to all this unemployment. Okay, so the three key answers to those three key questions that we had before. It's banks that create money. They create up to about £266 billion a year, although it's about £100 billion a year at the moment. And they pump most of it into property bubbles and speculation. So this is how far we are away from the textbook model of banking. Okay, so the consequences. Firstly, it means that when we allow banks to create all our money through lending, as they do at the moment, it means that the entire money supply is effectively on loan from the banks. So basically, we have to get all this money from the banks by going into debt to them, and then we have to pay interest on all of that back to the banks. So we're effectively, between all of us as members of the public, we're paying interest on every single pound in the economy, pretty much. But we're basically renting the currency from the banking sector. This is really a privatized currency. More importantly, it means that if banks don't lend, then there will be no money in the economy. And there's another implication of this. If we all start paying down the debt, as David Cameron advised us to do the other day, it means that the money supply will start shrinking. There'll be less money in the economy. That's going to be a big problem. If there's less money, it's like sucking the lifeblood out of the system, and people start losing their jobs, the economy slows down, and we have a recession, as we have right now. This system and all the incentives that we've seen earlier leads to the boom-bust cycle. It's nothing to do with the psychology of businesses or anything. It's all to do with banks pumping up these bubbles and then panicking and refusing to lend. I mean, this is really a house built on sand. The banks start off by lending more into the economy, and that kind of stimulates the economy and encourages people to spend more because they've got more access to credit. At least people are more confident of their income, their jobs doing well. They might get a pay rise because the economy's speeding up. They think, I can afford to take on some more debt. I'll get a house that's £1 million mortgage instead of £500,000. That means everybody ends up owing more, and then sooner or later, some of those people won't be able to keep making these repayments on an ever larger amount of debt. So they start defaulting. And then we've got the defaults, we've got less lending, the banks are panicking, people are still repaying their debts if they can do, so the money supply is shrinking. That leads to less spending, and that leads to your recession. This is your boom-bust cycle. Banks expanding the money supply and then panicking and shrinking it again. We're never going to have a stable economy if we have this kind of money system. And this is why every 5 or 7 years there's a recession that throws, millions of people out of work. It's completely unnecessary if you had a stable money supply that wasn't under the control of the banks. Also, when you have a recession, then people lose their jobs, they have to go on to unemployment benefit. Also, businesses are making less profit, so they're paying less in tax. So basically, the government revenue falls below what it was when they were almost breaking even. And when it falls, you're basically faced with the choice of, do we fire all the police? Do we close down all the hospitals and the schools? Well, no, we're not going to do that. So we need to borrow more add it to the national debt, basically. So this is what we have with the national debt. Now it's currently about £20,000 per person. And given another few years, we'll be looking at about £35,000 per person. And the impact this has for you is that your interest on the national debt, your share of the interest in the national debt, is about £81 a month. So you're paying this tax that you thought was the schools and hospitals, and it's going directly into the financial markets. As another consequence as well, it means that if you want to get out of debt, the only way you can do it pretty much is by getting money from people who have the money, which basically means if you want to get out of debt, you've got to push somebody further into debt. You want to get your head above the water, then somebody else has got to go deeper underneath. So this redistribution from the real economy to the financial sector, because all the real economy, the businesses, shops, factories need to borrow the money supply from the banks, and they've got to pay interest on it. Sorry, a lot of the businesses that are talking about not being able to borrow now, they're not trying to borrow because they need money to expand, because they don't really have any customers that have got any money to spend. They're trying to borrow money so that they can stay in business and not go bust. It's a cash flow issue. It's not about growing the economy. So even what the government's talking about getting banks lending to business again, it's not going to do anything. It's going to stop a few of them going bust, but it's not going to grow the economy. You've got to get money to consumers and to people who are actually going to spend it. We'll talk more about that later. So this redistribution from the rest of the UK back to the city, because Scotland, Wales, the south west, the north all need money to actually function, Northern Ireland, and they are redistributing this money. They're paying interest on all the money supply back to pretty much the city where the highest paid people are concentrated. So that's a redistribution from the periphery back to the centre. Okay. It's a parasite. Okay, so it's a major democratic issue as well. I mean, this is, on the left you have government spending between 2002 and 2007, a total of £2.1 trillion. And on the right you have total bank lending in that time, £2.9 trillion. Now this is all the money that the banks are allocating into the economy, and they are deciding whether it can be used for productive enterprise, for growing businesses, or whether it should be used for blowing up property bubbles or speculating in the financial markets. So they actually have more spending power than the government itself, which in itself is a real democratic deficit that we should be worried about. But it gets worse, because these 5 banks have 80% market share. So they effectively control around about 85% of the money in the UK economy. And these 5 banks are run by boards. The key decision makers are the guys on the boards of each of these banks. There are only 78 board members across all of these 5 largest banks. And I don't know if you know much about how boards work, but there's generally a lot of fillers who are there for their credibility and supposed expertise, but who aren't key decision makers. I mean, usually the key decision making team might be between 8 and 15 people. Particularly at the big banks, you get your core team there. So basically, we potentially have given, in the region of probably about 30 to 40 people, control over more money than the entire government has spent in 7 years. And that's a real reason to be scared. These guys are steering and controlling the economy. And we need to get some of that power back, and we'll talk about how we do that later on. So all of this is leading to the situation where we have Mervyn King saying that of all the many ways of organising banking, the worst is one we have today. And we couldn't agree with him more.